The notification appeared at exactly 2:14 in the morning. No alarm sounded. No explosion shattered the city skyline. No politicians rushed onto television screens announcing catastrophe. Outside the glass walls of a high-rise apartment, the modern world still glowed with artificial calm. Traffic lights blinked rhythmically over rain-soaked streets. Delivery drivers moved through intersections carrying late-night meals to people scrolling endlessly through glowing screens. Somewhere in the distance, an airplane crossed the clouds above the city like a floating constellation. Everything looked stable, and that was precisely what made it terrifying. The man sitting alone at the kitchen table stared silently at his phone screen while cold blue light reflected against the dark apartment walls. Temporary withdrawal restrictions are currently in effect. At first, the sentence felt almost meaningless. Temporary. Restrictions. Effect. Sterile words. Corporate words. Words designed to sound emotionally empty. He refreshed the banking app once. Then again, the number inside the account remained unchanged. Years of work still existed digitally, suspended somewhere inside invisible systems. His salary deposits, his savings, his emergency fund. Technically, nothing had disappeared, but something far more unsettling had happened. The money was still his. Yet access to it suddenly depended on permission. And in that moment, a realization older than civilization itself began resurfacing beneath the polished surface of the modern world. Ownership and access are not the same thing. By sunrise, the language on television became strangely careful. News anchors maintained calm expressions while quietly introducing phrases like temporary stabilization measures and preventative liquidity controls. Economists spoke in technical vocabulary meant to soften psychological panic. But panic has never cared about vocabulary. Across the city, people began lining outside ATMs before banks officially opened. Some machines stopped dispensing cash within hours. Transfer limits quietly appeared. Small businesses started refusing. Digital payments out of fear that settlements would freeze before funds arrived. The city still looked normal, cars still moved, coffee shops still opened, stock markets still flashed numbers across giant electronic screens. But beneath the surface, trust had started cracking. And modern civilization runs on trust far more than people realize. That is the hidden architecture nobody thinks about when tapping a payment card against a machine or checking an account balance through an app. The entire financial system feels physical even though most of it is psychological. Money today is largely belief organized into digital form. And belief can change frighteningly fast. This is why history keeps repeating scenes civilization promises are impossible. In 2008, major financial institutions collapsed within days, despite appearing indestructible only months earlier. In Cyprus, bank depositors watched portions of savings disappear through emergency bail-ins. In Lebanon, citizens stood outside locked banks begging for access to lifetime savings trapped inside a collapsing system. In Argentina, generations learned to convert paychecks into dollars immediately because inflation consumed value faster than trust could survive. Every society believes instability belongs to other countries, other eras, other people, until suddenly it belongs to them. And this is where the illusion becomes dangerous. Because modern people are taught from childhood that visibility equals safety. Deposit money into regulated institutions, report everything, centralize investments, trust systems designed by experts. The more visible wealth becomes to institutions, the safer people are told it is. But history reveals an uncomfortable contradiction. The moment systems become unstable, visibility often becomes vulnerability. And strangely, the people closest to power seem to understand this instinctively. Billionaires quietly buy farmland across continents. Wealthy families establish trusts in multiple jurisdictions. Governments themselves diversify reserves away from foreign dependence. Central banks accumulate gold while publicly insisting fiat systems remain strong. Corporations move intellectual property through invisible international structures stretching from Singapore to Ireland to Switzerland. A paradox begins emerging from the shadows. The same system that publicly encourages concentration privately rewards diversification. And perhaps the most unsettling part is that this pattern is not hidden at all. It is happening openly, quietly, constantly. The wealthy entrepreneur purchasing a second passport is not behaving irrationally. The investor storing part of his wealth in precious metals is not necessarily paranoid. The government diversifying reserves away from single currency dependence is not preparing for fantasy. They are responding to historical memory, because history leaves fingerprints on intelligent behavior. And history repeatedly teaches one brutal lesson: systems change faster than ordinary people emotionally prepare for. Empires once believed eternal disappeared into museums. Currencies once trusted completely became worthless paper. Political orders collapsed so suddenly that entire populations woke up inside realities they could barely recognize. Yet every generation somehow convinces itself modern technology has eliminated ancient instability. As if smartphones erased human nature, as if digital banking apps abolished fear, as if algorithms removed political incentives from financial systems. But technology does not remove historical patterns. It accelerates them. A bank run no longer requires crowds smashing through doors. Now panic travels silently through phones at the speed of information. Confidence itself has become digital, and once confidence begins evaporating, modern systems move quickly to preserve stability. That is what makes this subject psychologically uncomfortable. Because most restrictions introduced during crises are not presented as oppression, they are presented as protection. Protection for markets, protection for liquidity, protection for the banking system, protection for society itself. And sometimes those measures genuinely prevent greater chaos. But they also reveal something civilization rarely wants to admit openly. Modern finance is built less around absolute ownership and more around managed access. The distinction sounds small until access becomes uncertain. Then suddenly, everything changes. A salary becomes dependent on infrastructure. Savings become dependent on policy. Transactions become dependent on approval. Freedom itself becomes partially conditional. And throughout history, the individuals who recognized this earliest behaved differently from the general population. They diversified geographically. They accumulated portable assets. They created multiple financial pathways. They reduced dependence on any single institution, currency, or jurisdiction, not because collapse was guaranteed, but because concentration creates fragility. Nature understands this instinctively. Forests survive through biodiversity. Species survive through adaptation. Systems built entirely around single points of failure eventually break under pressure. Yet modern humans increasingly centralize every aspect of life into interconnected structures requiring constant stability to function properly. One banking system, one digital identity, one currency, one government framework, one stream of permission-controlling economic movement. And most people interpret this not as exposure, but as convenience. That may be the greatest paradox of the modern age. The systems making life feel safest may also be making individuals more vulnerable than they have ever been before, which raises a question becoming harder to ignore. Why are governments diversifying reserves? Why are billionaires purchasing hard assets? Why are parallel financial systems quietly emerging outside traditional banking? And why are legal methods of moving wealth beyond immediate systemic reach becoming increasingly attractive in a world supposedly more advanced, more stable, and more connected than ever before? Because beneath the smooth surface of modern finance, something deeper is shifting. Something historical, something psychological, something civilization has seen before. The greatest illusion of the modern financial world may not be that money can disappear. It may be that people confuse seeing numbers on a screen with true ownership. And history has punished that misunderstanding many times before. Long before digital banking apps, stock exchanges, and central banks existed, human beings already understood a dangerous truth about power. Wealth that remains trapped inside unstable systems rarely survives instability. Centuries before modern finance created the illusion of permanent security, merchants crossing medieval Europe traveled with hidden gold stitched into clothing, concealed inside cargo compartments, or dispersed through trusted trade networks stretching across kingdoms. They did not behave this way because they were criminals. They behaved this way because kings were unpredictable. A ruler facing war, debt, or political unrest could suddenly invent new taxes, seize property, debase currency, or confiscate wealth under the language of national necessity. Entire fortunes disappeared not through theft in the traditional sense, but through changing rules, and history reveals something deeply unsettling. The rules always change fastest during periods of fear. In Renaissance Italy, wealthy merchant families like the Medici understood that survival required diversification across geography, politics, and currency systems. Wealth concentrated in one city could vanish with a single regime change. But wealth spread across trade routes, ports, land, precious metals, and foreign relationships became harder to destroy. Financial mobility became a form of armor. Then, centuries later, another empire collapsed beneath the illusion of permanence. Russia. Before the revolution, aristocrats lived inside unimaginable luxury. Palaces glittered beneath chandeliers while servants moved silently through halls filled with paintings, gold, and imported silk. To the wealthy class, the social order appeared eternal. Their assets were immense, their political influence overwhelming, and then history accelerated. Within months, fortunes built across generations became meaningless inside a collapsing political reality. Estates were seized. Banks became inaccessible. Ownership itself was rewritten by force. Some families escaped, carrying portable wealth, diamonds hidden inside clothing, gold coins sewn into fabric. Foreign bank connections established years earlier. Others remained wealthy only on paper, while everything around them transformed into chaos. The difference was not intelligence. The difference was mobility. And history repeated the lesson again, during the Great Depression. In 1930s America, bank runs spread like psychological wildfire. Men wearing expensive suits stood beside factory workers in lines stretching across sidewalks before sunrise. Everyone wanted the same thing: access, because most people had unknowingly confused account balances with physical possession. Modern banking had already evolved into something abstract long before ordinary citizens understood what that meant. Banks no longer stored every depositor's money safely inside vaults waiting patiently for retrieval. The system operated through lending, leverage, circulation, and confidence. As long as trust remained intact, the machine functioned beautifully. The moment trust fractured, the illusion became visible. And perhaps that is what makes financial systems so psychologically fascinating. They resemble massive concrete structures from the outside, but internally, they operate more like collective belief systems. Civilization itself rests upon invisible agreements people assume will continue forever, until suddenly they do not. Decades later, Argentina became one of the clearest modern examples of this recurring historical cycle. Inflation there did not simply reduce purchasing power. It transformed the psychology of daily life itself. People rushed to convert salaries into US dollars immediately after getting paid because local currency behaved like melting ice. Entire generations developed survival instincts around financial instability, Citizens learned never to trust permanence completely because the system repeatedly betrayed certainty. And still, every crisis was initially described as temporary. Temporary restrictions, temporary controls, temporary emergency measures. History loves that word. Temporary policies often leave permanent psychological scars. In Greece, during the sovereign debt crisis, ATM withdrawal limits reminded citizens that access to money could become conditional overnight. In Cyprus, bank depositors discovered that savings inside financial institutions could partially absorb systemic losses through bail-ins. In Lebanon, ordinary people watched banks effectively imprison personal wealth while inflation devastated purchasing power outside the system simultaneously. The pattern keeps repeating across centuries, continents, and political ideologies because the underlying incentives never truly disappear. Systems prioritize survival, always. Not because every leader is evil, not because collapse is always planned, but because institutions facing instability instinctively centralize control. That instinct exists everywhere in nature. An injured animal conserves energy. A threatened government restricts capital movement. A stressed banking system limits withdrawals. The reactions are structurally predictable, and this creates one of history's darkest paradoxes. The systems designed to create stability often become most restrictive precisely when stability disappears. Yet despite thousands of years of historical warnings, modern civilization has become more financially centralized than almost any society before it. Previous generations often held physical cash, precious metals, land, livestock, foreign relationships, or independent trade assets. Their wealth existed partially outside centralized structures because technological limitations prevented total integration. Modern people live differently. Now salaries arrive digitally. Savings remain inside banks. Investments connect to centralized markets. Transactions pass through monitored networks. Entire identities revolve around financial systems requiring uninterrupted institutional functionality. One disruption can freeze everything simultaneously. And perhaps the strangest part is how normal this feels, because convenience creates emotional dependency gradually. The easier systems become, the less people question their fragility. A smartphone replaces physical cash. A digital wallet replaces tangible ownership. Automation replaces understanding. And slowly, people stop asking deeper questions. Where is the money actually held? Who controls? Access during crises? What happens if systems malfunction politically, economically, or technologically? History suggests these questions matter far more than societies realize during stable periods, because stability creates historical amnesia. Every generation believes its technology has conquered ancient instability. Romans believed their empire represented permanent civilization. European powers believed global dominance would last indefinitely. Financial institutions before 2008 believed risk had become mathematically manageable through modern innovation. And every era eventually collides with the same uncomfortable reality. Human systems remain human systems, fragile, political, psychological, temporary. Throughout all these transformations, however, one category of wealth repeatedly survived better than others. Portable wealth. Gold hidden during war. Foreign assets beyond. Collapsing regimes. Land outside unstable jurisdictions. International trade. Relationships. Multi-currency diversification. Mobility itself became protection, not perfect protection, but options. And options become priceless when systems harden unexpectedly. This is why the wealthy throughout history rarely concentrated everything inside one structure, one country, or one form of value. They understood something ordinary citizens often discover too late. Financial freedom has historically belonged not merely to the richest people, but to the most adaptable. And now, for the first time in modern history, ordinary individuals are beginning to rediscover the same question elites quietly studied for centuries. What happens when the systems people depend upon become unstable, faster than they can react? To answer that question, you have to look beneath history itself. You have to examine the invisible mechanics holding the modern financial world together. At street level, the world appears divided by borders. Flags wave. Above government buildings, citizens pay taxes to individual nations. Workers receive salaries denominated in local currencies. Political debates revolve around domestic policies as though economies exist independently from one another. But high above ordinary life, wealth, moves through an entirely different reality, a borderless reality, invisible, fluid, constantly shifting through financial arteries most people never see. At this very moment, while an office worker checks a bank balance in one country, capital worth billions of dollars is quietly traveling across continents in seconds. A corporation routes profits through Ireland. A sovereign wealth fund acquires infrastructure in London. Gold shipments move eastward into central bank vaults. Lawyers in Switzerland establish trusts protecting assets connected to families living thousands of miles away. The modern financial world resembles an enormous nervous system stretching across the planet, and the wealthiest participants rarely keep their survival tied to one nation alone. That is the first major illusion global finance quietly destroys. Ordinary citizens are taught to think nationally. Power thinks internationally. In Singapore, private banking towers manage fortunes diversified across currencies, jurisdictions, and asset classes. In Dubai, investors quietly purchase international real estate while establishing residency pathways outside their home countries. In Switzerland, wealth preservation firms help families structure assets across generations using legal frameworks designed specifically for long-term stability. And somewhere in Iceland, inside cold server farms surrounded by volcanic landscapes, digital infrastructure processes transactions detached almost entirely from geography itself. Meanwhile, ordinary workers remain deeply connected to one system, one salary, one banking network, one political environment, one currency exposed to the policies of a single government. The contrast is astonishing once you notice it. The same globalization criticized publicly is often used privately by elites as protection against local instability. That is the paradox hiding beneath modern economics. National systems ask citizens for loyalty, while global capital survives through flexibility, and governments themselves behave this way too. For decades, many nations stored reserves heavily dependent on the US dollar. In recent years, something subtle began changing beneath the surface of international finance. Central banks around the world started accumulating gold at accelerating rates. Countries explored trade settlements outside traditional dollar system,